I think it's wonderful when we come to almost the end of one of our symposia and people are talking to each other more now than they were at the beginning. So it's obvious that we've sparked a number of exciting discussions. We're very fortunate to have with us this morning our keynote speaker, which will be more of a fireside chat sort of setup. Sheila Bair, and I think I'll let Richard introduce her formally. There's also a bio, but she has many, many accomplishments, including having been the head of the FDIC during the financial crisis. So she has a few scars, I would suspect. None of them are showing. And our moderator is my dear colleague, Richard Herring, in the finance department at the Wharton School. He is an expert on financial institutions, and so he is clearly the right person to be moderating this discussion. So I think the two of them will have a conversation for a bit, then we'll open it up to Q&A, and we will finish whenever you guys feel like finishing, or by 11:45, whichever comes first. Thank you.
Thanks, Olivia. And it's my great pleasure to welcome Sheila to Penn. She's actually been very generous and appeared here a number of times, but Sheila's career has been really quite remarkable. She's served in the Clinton, Bush, and Obama administrations. She was a member of the Senate staff, I think, with Bob Dole, because actually you're from Kansas, as I recall. She was head of the FDIC in an extraordinarily turbulent but innovative era, which really has sort of repositioned the agency in a major way. When she stepped down, she became president of a university. I guess it's still, strictly speaking, a college, although everybody pretends to be a university these days. And so she knows a lot about student debt and that sort of thing as well. So we have a wide range of things to talk about. I guess I'd like to begin by mentioning how I first became aware of Sheila. I'm sort of a voyeur on the international banking world. And there was a meeting of the Basel Committee, this group of international regulators that has had the responsibility of trying to frame the general regulatory apparatus for the world system. And for more than 20 years, they'd worked on a system that was entirely focused on risk-weighted assets. And it was always a matter of looking at capital, which was not very well defined, relative to risk-weighted assets, which had sort of an arbitrary weighting, and actually a weighting that could be easily manipulated. Well, in her first meeting, as I recall, and I read this from the news accounts, I didn't actually hear it from Sheila, but I think it was in Mexico City, and you probably were the only female there, and you said, you know, we really ought to have a leverage ratio. And they were aghast. It was like saying the emperor had no clothes at all, but it wasn't apparent until the actual crisis that she was absolutely right. Focusing on risk-weighted assets had actually caused the system to be incredibly over-leveraged, such that some of the European banks were really operating with leverage of 50 or even 100 to 1, which means that the slightest change in the value of their assets put them really into insolvency. And we lived through that, which was not a pleasant experience. They finally, I guess, actually voted you an apology when we now have leverage in the system, but it was resisted not just by the Europeans, but by the Fed as well for a very long time. But now it is, I think, well accepted that you do have to pay attention to leverage no matter what you think you're doing with risk-weighted assets. Well, Sheila obviously was present at the crisis and was with everybody else trying to quell the flames. And afterwards, she was very instrumental in building the new regime. And I guess maybe that's where we should start. What is it you think has really worked well about the new regulatory regime? What remains to be done? And maybe finally, what concerns you looking at the current state of play?
Well, first of all, let me return the favor because I got to know Dick when we were fighting this battle against risk, really exclusively relying on risk-weighted assets as a measure of capital adequacy. And the problem was compounded by the international regulators, including in the US, trying to move to something called the Basel II Advanced Approaches, which really relied heavily on a bank's own models to determine how risky the assets were. And Dick was one of the brave academics who had been speaking out on this at the time and really was helpful to the FDIC in providing some of the analytical support and intellectual heft to argue against what turned out to be very, very ill-advised capital framework and a hard lesson learned on that. So the good news is we did finally get a leverage ratio in the Basel Committee. I'm afraid it was only 3%, but even that was a sizable heft for these European banks that had were so heavily reliant on debt. And unfortunately, we still have the Basel II advanced approaches, but there have been a lot of bells and parameters and floors put around that, including the Collins Amendment in the U.S., which we pushed for to make sure that these advanced approaches couldn't lower capital levels for big banks to unacceptable levels. And so I think that is an improvement. The stress testing has been an improvement. We have increased capital requirements. In the U.S., we have a much higher leverage ratio, 6% for the systemic banks, 6% for insured banks, 5% for the entire financial organization. And so those increased rules plus the stress testing process has resulted in a much more strongly capitalized system. Now, is it enough? No, I don't think it's enough because we were starting at extremely low levels. But it's certainly, so people ask me, is the system safe? I say it's safer. I can't say that it's safe. I think 5% leverage ratio, and I think that's still the most important metric in determining capital adequacy. That still allows these very large, complex institutions to fund themselves with 95% debt. That's still a lot of leverage. So I think we could go a lot higher. We have not, but it is a huge improvement.
Sheila, may I interrupt for a second? One, here's the response from the regulators currently that it's all done, that we have enough capital in the system so that there's no need to worry. And they may be right. The next crisis may well break out somewhere outside the banking sector. But they point to the fact that we now have so much capital in the system that even if we should replay 2008 and 2009, we'd end up with banks that still met capital requirements.
So a couple of responses to that. I think, and others have written about this, the stress test assumptions, they have a bias. They don't include, those loss rate assumptions don't include the banks that failed. So that's kind of, so I think that the loss rates assume, everybody focuses on the stress scenarios that the Fed does publish in terms of how robust the stress tests are. But what you really need to look at is what are their assumptions of how much money a bank will lose under those stressed scenarios. So I think that the loss assumptions could be more stringent. I also deeply regret they proposed this, they haven't finalized it. One of the things the Fed did under Dan Trillo's leadership, which I strongly supported, was to require not only that they maintain capital adequacy in stress positions, but actually can continue lending, can continue functioning. And so they're getting rid of that requirement, or they propose to get rid of that requirement as a component of the stress test results and whether you pass the stress test, which I think is really unfortunate because the regulated banking sector, we give them insured deposits, we give them access to Fed lending facilities. We do that just not because we want them to make a lot of money. That's not the reason we do that. We do that because we want them to be able to function through the cycle. And if you get into a downturn, we saw this happening exactly beginning in 2007. The non-bank lenders and the non-banks were the majority of these subprime mortgages. They collapse. They're the first ones to collapse. And whatever credit intermediation that those non-banks were providing is going to collapse back into the regulated sector. The regulated sector does not have the capital adequacy, not just to survive and not become insolvent, but actually expand their balance sheet to pick up the slack, then you've got a problem. So no, that was probably more of an answer than you wanted, but I don't think we're nearly where we need to be. The stress test last year, they actually let banks pay out in shareholder distributions more than they earned, so they were depleting capital. And this is another thing that frustrates me about people talking about capital constraining growth. Well, you find when we loosen or weaken those capital constraints, the money goes out to shareholders. It doesn't stay in the bank and used for quote unquote lending. So I think there are a lot of myths around this that need to be corrected.
Yeah, and I think you're pointing out a very clever way in which capital requirements are effectively reduced without actually confronting
being a
the
bit,
issue.
yeah,
Because if you let banks assume that they can run down the asset part during a crisis, then they have to hold less capital overall.
right.
So it's a very clever way of reducing capital requirements without confronting the issue head on.
Exactly. Yeah, I think that's very true. So I think we are, again, we're safer. I think there's a lot of fragility in the system, though. I think another key part of Dodd-Frank was the Title II Resolution Authority. So during the crisis, we did not have really a playbook, a standardized process for resolving non-bank financial institutions. And most of the big investment banks, Bear Stearns, Lehman Brothers, those were not within the FDIC's jurisdiction. They were not insured depositories. So Dodd-Frank created a new framework in Title II to give the FDIC the authority to use the same types of tools it has long used for insured banks to resolve these larger non-bank institutions in a way that can continue funding them so that their essential operations can continue, so you don't have a systemic impact in terms of the real economy's reliance on key services. But you do have the ability to take control of them, impose losses on shareholders and creditors, restructure them as needed, and spin hopefully a smaller, cleaner institution out of the process. So that's something we didn't have during the crisis. We do have now.
May I interrupt
sure.
just a second, because a question I often get from students is, well, we had the FDIC, and the big problems were the banks. Why couldn't they do it?
Right.
What was your problem in dealing with a Citibank?
So Citibank, well, there were two things, and this goes right to the heart of some of Dick Herring's good research. So first of all, Citi's risk. Citi was a huge conglomerate, right? A huge international conglomerate that had done a lot of acquisition activity and had not done much to rationalize all these entities that it acquired. So we joked, we were not the primary regulator of Citigroup when we actually started taking a serious look at them because we were worried about their solvency. You couldn't find the bank, right? The organizational structure was such a morass. You didn't know where the bank was. And of course, our resolution authority only applied to the bank, wherever it was. So a good share of it, of their activities, especially their high-risk activities, were being done. It really, their bank, such as it was a place to book assets. It didn't function otherwise. So to apply, and this is another important part of Title II resolution planning, and it's also required under Title I, which requires the non-bank pieces of these large conglomerates to try to organize themselves and plan so that they can actually go through a traditional bankruptcy process. I think that's got some challenges there. But a key part of this resolution planning is to get them to rationalize their legal structure so you can actually see where the component parts are, which is really essential for dealing with a failed entity. But anyway, so we have that. We didn't have that playbook in 2008 and 2009. We have it now. I think that's really important. We had the Financial Stability Oversight Council, which has been weakened a bit, I think. We had the Office of Financial Research, which has definitely been weakened, and I think that's really unfortunate because some of the fragility in the system relates to, again, bank and non-bank lending activity and lack of coordination among the regulators to know where the risks lie, especially leveraged loans. I heard somebody ask earlier about leveraged lending. Good for you. It's a huge risk for the system right now. And we don't know, banks are doing some of that, non-banks are doing some of that, the banks are funding the non-banks who are doing that. We've got other financial institutions, so it's just like subprime except with corporate loans to highly leveraged companies. So they're bundling them up into what's called CLOs, basically an securitization, selling the pieces off to supposedly diffusing the risk. But who knows where all that is. So I think OFR could have played and would play a central role in trying to identify where these risks are and how to manage them, but OFR has been downsized a lot. I'm not quite sure why, but it has. Similarly, both Title I and Title VIII gave regulators new authorities to regulate systemic activities, not just systemic institutions. And again, leveraged lending would be a prime case where you would want to look across the system because you've got banks and non-banks doing it to try to set some standards, especially on how leveraged these entities can be to get this funding. But we're not seeing effective use of those tools. So
how could that work in our current system that really is very institution and agency specific.
Right.
We have people who look at broker-dealers and people who look at banks, and
Right.
FDIC now has a somewhat broader view. But there's really nobody looking at the stuff that's going on outside the system. And so it's hard to see how FSOC would ever have a very active role to play, lacking both sort of authority, well, it has authority, I guess, but lacking the knowledge to know how to intervene.
Yeah, so I don't know. So we'd pushed, FSOC was actually something that I had proposed for the Senate Banking Committee. We'd originally proposed it in my testimony as having rule writing authority itself. If you couldn't get the regulators to agree and cooperate, that the FSOC could actually step in and write a rule itself. We were not, both Treasury and the Fed did not like that, and we lost that, but I think that could help address this. So now you've got what's called name and shame authority by the FSOC, and FSOC used that with the SEC when the SEC was not moving forward with money market fund reforms that others thought were really needed to address some very concrete systemic issues that occurred when the Reserve Fund broke the buck, after the Lehman failures. So that is one authority, but you've got to be willing to use it. The Fed, though, and the bank regulators, I think they tried actually to do guidance on leverage lending, at least for bank leveraged loans, to put some parameters around how leverage the company could be. I think they had a 6-to-1 leverage ratio. It's a different kind of ratio than what we would talk about with banks. And that was invalidated. The Congress didn't like that and said that had to be approved by under the Congressional Review Act, and I guess the regulators didn't want to pursue that. So you're right, there's still a morass of obstacles to effective systemic regulation.
Looking forward, the White House has now tried to put in place a process that would sort of derail guidance, which has been a primary tool. It's all supposed to go through the OMB, which will decide whether it really should be a rule. And it could slow everything down for sure, and it could really make it much more difficult to do modulated interventions as opposed to...
I think that's right. We made heavy use of guidance during the crisis. We needed to. It was fast. It was quick. And the banks wanted it, right? We were giving them some rules. Here's what you do. Here's what you don't do. Especially getting mortgages modified. We heavily used guidance to set some parameters, which they wanted. So this idea that guidance is always something banks hate is not right. Sometimes it's welcome. And I don't think the banks themselves is in their interest to have, for an independent regulatory agency, to have to go through a separate process at the White House from people who do not have the same expertise that they have or the same information they're looking at that prompted the guidance. So yeah, I think that's a singularly bad idea. But again, it's just symptomatic of the broader trend in Washington for loosening regulation and weakening the ability of regulators to step in.
Where do you see the troubling accumulations of debt or other excesses in the financial system? We live in an era that's, I think, unusual in history in terms of very low interest rates that, at least in the U.S., are modestly above zero, but in much of the world are below. And my concern is that the main thing that the monetary authorities have been good at is inflating asset prices, but haven't had much traction with regard to consumer prices. And that strikes me as a little like Japan in the 1980s, which had a very unhappy outcome.
It did. No, I don't disagree. I think low interest rates basically stimulate the economy by encouraging people to borrow and disincentivizing them to save, and by inflating asset valuations. And all this debate around Stephen Moore, and he's withdrawn, and I don't take a position on that. But to the extent I think some fresh thinking about monetary policy and are they looking at the right metrics, this singular focus on consumer price inflation, and so they want to stimulate, that 2% target, which has gotten religion around it. I don't understand. Deflation really hasn't been. Paul Volcker's talked about this. Deflation has been a problem basically since the Great Depression, but they're obsessive about not. And a little deflation isn't necessarily bad. That's another way to boost real wages. So, and then the Fed, they kind of celebrate. It's the wealth effect, right? So, good, the stock market's going up. This is great. This is great for the economy. We're getting the wealth effect.
That's trickle-down economics at its worst.
But then when wages go up, we got to raise interest rates. So when actually it's just completely upside down. I think if I were them, I'd be looking more at asset prices. I think it creates financial instability. It does create dangerous bubbles. This idea you can't see a bubble. You can see a bubble. You don't know when it's going to pop, but you can absolutely see a bubble, but then there's kind of the antagonism towards real wage growth, that's going to stimulate consumer price inflation. Real wage growth is a sustainable way to drive economic growth, unlike consumer borrowing, especially when it outpaces real wage growth, which it has been doing and certainly did prior to the crisis. That will end in a vale of tears. So yeah, I think there are a lot of parallels and a lot of need to rethink the role of monetary policy. If you want the role of monetary policy to be, the primary means to stimulate economic growth, understanding that it poses these risks of unstable asset bubbles and over-reliance on debt to fuel growth, which is ultimately unsustainable. At some point, you just can't borrow anymore.
What are the buildups of debt that concern you most in the economy over the medium term?
Yeah, well, I was reading some of the papers and listening to the conversation this morning. I think you've all done an amazing job looking at it. I think, and this was mentioned earlier, non-financial corporate debt is at a significant historic highs. And then within that broad category, the high-yield debt market and then leveraged loan market are also very, very high. Leveraged loans, the similarities between leveraged loans and subprime mortgages are really eerie. They're both about 1.3 trillion. So subprime was about 1.3 trillion when it peaked. That's actually leveraged loans are a little bit north of that now. It's the originate to distribute model. So we're hearing, oh well, we're originating these loans, but the risk is being dispersed to all these investors through collateralized loan obligations. We're hearing that banks don't make most of them, that non-banks are making both of that. We heard that during the subprime crisis. And we heard, don't worry about it, it's not going to be a problem. And I don't buy any of that. I worry particularly, so let's just look at the leveraged loan market. According to their own trade group, those highly leveraged companies, and these are household names, this is CVS, I mean, these are not parameter names. Yes, yeah, it's kind of a scary list. And they employ about 7 million people. And, so what happens when they can't borrow anymore, or because they are so highly leveraged, they can't access credit anymore? In December, when the Fed decided to go ahead and raise rates, the market froze up, as you might recall. Any company that was highly leveraged could not access credit. I mean, it just shut down. The high-yield debt, leveraged lending just shut down. So bank on it that could very well happen again if we get into an economically distressed environment. Something spooks the markets again. So what's going to happen to those 7 million people that these highly leveraged companies employ when they can't access credit anymore? Because they've got credit lines with these big banks. They've got other continual funding needs. These leveraged loans are variable rate. The interest rates will go up. Some of them are shorter term. They have to be refinanced. So what's going to happen? That worries me because for the subprime, we had kind of two waves of problems. The first wave was with banks pulling back on credit because they were too highly leveraged themselves. They didn't have the balance sheet, right, to continue to lend to the real economy. And then you had that second wave, which your speaker last night wrote about in House of Debt. And he argued, and I agree with this, that the real hit, the reason why we had this long, deep recession, and it was a long recession for most of America. The banks may have come back quickly, but it was a long recession for most of America. It was the hit to consumer spending because of home prices. You couldn't refinance anymore. You couldn't use your home as an ATM. Not only that, but you all of a sudden had a resetting unaffordable mortgage, and you were putting your money into that to try to save that home as opposed to spending places. So that took a little bit longer to trickle through the system. But with leveraged loans, I think it could be a very immediate impact because, again, these companies are large companies that employ a lot of people. So if I were the regulators, and I'm not anymore, but if I were them, I would be looking at those leveraged loans. I would be looking at the ability to restructure those loans. I would be looking at the ability of the large banks to continue to provide credit to stabilize those companies as they get into trouble, and they're going to get into trouble. We tried to do that in the spring of 2007 as we saw the subprime crisis going. We got everybody together and we were looking at the subprime mortgages and the securitization trust. What are the authorities to restructure those mortgages? What's going to happen to these borrowers? How can we preserve home ownership? I think I hope regulators are going through that same kind of analysis now because I think if that's the top of my list of things to worry about with a system that is still overly reliant on debt. And I think it's going to end badly.
One thing that strikes me as different about the leverage loans, and I don't really know the figures well enough to be really definitive about it, but I have the impression it's being distributed differently than the subprime debt. that a lot of it is ending up in pension funds and retirement plans. And there's a sense in which that may be safer hands and that they'll be less likely to have a run, but it's also a little bit worrisome in terms of controlling our future.
Yeah, I mean, so they're going to have losses on those CLOs. There's no doubt about it, and the banks will too. The banks buy a lot of it, even though they may not originate it, but they fund the people to do, and then they buy it. So the losses will be widespread. The resiliency of the systems to absorb those, I think, is a question that FSOC and OFR should be looking at, and they're not. But I agree that is a big concern. But I think another concern that people really are not looking at is what happens to these companies themselves, the borrowing companies. What happens to them and their employees when they can no longer refinance or access credit? So I think it's part of a broader problem, and people need to identify where the losses are going to be, but they also need to identify how can you keep these companies function and avoid massive layoffs when the credit markets freeze up for them, because they will freeze up for them. I think so. On the positive side, though, in terms of restructuring that debt, it may be easier than it was for us for the subprime mortgages, because we were dealing with millions of homeowners,
Right.
whereas here you're dealing with fairly sophisticated, presumably corporate borrowers. So the ability to engage in restructuring when that need to happen, and it will happen, it may well be easier, fingers crossed. But again, I think that's exactly the kind
And
of thing
for
we're
many
really
of
should be
them,
looking at now.
bankruptcy is a financial strategy rather
Yeah,
than.
it can be,
but,
yeah, and there are
that has problems
that's
as
right.
well.
And
but
this is also true. Please.
there's another area of debt that seems to have a lot of political saliency, looking at least in one side of the aisle, and that is student debt.
Yeah,
People are becoming concerned that it is it's impeding mobility. It's causing a whole generation to be slower to become American homeowners. You can hear it hyped a lot in the campaigns these days. In fact, it's really no more than auto debt, which we don't seem to worry about. But what's your view? You've looked at it from all sides.
More than auto debt. Well, I'll have to check it. It's growing.
I think it's quantitatively about the same.
Is it? Well, we're a little over 1.5 trillion now. I'd have to check my recent. Well, I worry about auto debt too. But look, I think so. Non-mortgage consumer debt is also at historic highs. So, and that's not good, because mortgage debt, right? A lot of the reason the mortgage debt is lower now, or that it's not at historic highs, I should say, as a percentage of GDP, is because people lost their homes, or they lost their, or their home prices went down. And this particularly hit lower and lower middle income families. So the loss of home ownership hit those segments, and that's where you're seeing a lot of the higher borrowing rates with credit cards,
Yep.
with auto, a lot of subprime auto, and also with student debt. And it's these Parent Plus loans that are in particular causing problems for minority families. They're disproportionately taken out by minority families. I've seen some research that's hitting the retirees, right? These Parent Plus loans, these are basically loans the government provides that help a parent pay for their student's college. So an undergraduate is capped out for student borrowing, for government student borrowing, about $29,000, I think, for the whole 4 years. And as most of you know, if you have parents, I know my guess is you couldn't go to Wharton for 29. Well, it's a graduate school, but maybe the end. Maybe. Anyway, that's so. The government says, okay, we'll make Parent Plus loans too, and these are not subsidized rate loans. These are market rate loans. And there's really no effective cap. The cap is based on cost of attendance. So whatever the college is charging for room and board and tuition, you can make up that gap with your Parent Plus loans. And so I think there was and it's eye-popping. I think the average, something like $64,000 now last spring when students graduated, their parents had Parent Plus loans. So, and that's probably after the student maxed out on their student loans, right? Because those are lower interest rates. So this is a huge problem. It's concentrated particularly badly in minority families, and it's hitting retirees now too. And the government's pretty no nonsense about student loan collection. They'll garnish your Social Security, they'll garnish your wages, and a lot of that's happening right now. So that is a segment of non-mortgage debt. And people say, well, student debt's good because it's an investment, right? You're going to get a return. Should be. But it isn't always. 40% of the students don't even graduate. They got debt but no degree. Some of the schools are not providing value. Certainly not an outstanding institution like this, but there are a lot out there that are not. That the costs that they're charging far exceed any reasonable return on investment that the student will get. The transparency around the true costs of college and the true cost of the debt to finance that college is terrible. So I think it doesn't, rationalizing student debt that is an investment in the future. Some of it is, a lot of it isn't. And it just, the kind of financial burden we're putting on our young people and also their parents is really disheartening. So I think, so the good news is if you look at all consumer debt, it's not historic highs as a percentage of GDP. If you look at non-mortgage debt, it is. But I think you also need to look at the distribution of that debt among income levels. And the non-mortgage debt, again, is increasing among the lower middle income families. And they are, again, getting back to the economic impact, they are a heavy driver of consumer demand and spending in our U.S. economy. So when they're getting too levered, and thank God we're seeing some real wage growth now, and hopefully that'll help, improve their ability to service that debt. But I think this is another place of system fragility that really requires close watching.
There are a number of proposals to deal with that particular problem in the campaign just now. And I wonder if any of them are attractive to you in the sense of you think it would actually make things better as opposed to simply pushing it down the road and creating perverse incentives.
Well, look, I think we need to do something bold and dramatic. I think this is we've been tinkering around with this program on the edges and frankly adding a lot more complexity to, adding yet another income-based repayment option that nobody can figure out, and lots of tricks and traps, and a lot of kids don't qualify because they don't have the paperwork or the administrative traps that are set for it. So I've been a big advocate of something called income share. And so income share, you just scrap, at least for undergraduate education, just scrap debt as a model for financing an undergraduate's education. It's a contract between the student and the funder for the student to pay back a certain small, affordable percentage of their income, what they actually make for a period of years up to a cap, and then they're done. And so Purdue has pioneered this. There are probably a little over a dozen schools now who are offering ISA. Some of them they're offering it as a complete alternative to debt. Others are offering it as an alternative to high-cost debt, private debt, but not for subsidized federal debt. And there's some of the unaccredited schools, like the coding schools, are using ISAs very successfully. Of course, you have very high incomes coming out of a coding school, so it particularly works for that model. But I think we've played around with this. Australia and the UK use a system similar to that. There's some other issues there, but not so much with repayment. I mean, it's basically a flat tax, right, on people who use the government to help them finance their education. That's how it's viewed in the UK. You do cross it, so the high earners, the people that go out, the engineers or the hedge fund managers or whatever, they're going to have more income, so they're going to pay the same percentage, but a higher dollar amount, obviously, than the policemen or high school math teachers or what have you. That doesn't bother me. I think that's a strength and not a weakness of it. But the important thing is everybody's got an affordable payment, and it fluctuates with what you actually make. And if you actually require the school, which is why I like, the fact that you've got about a dozen brave schools that are doing this on their own now, they're actually putting the funding into it. They're nicely aligning their own economic incentives with their students, because if their students don't graduate and get jobs, they're not going to be able to recoup their cost in funding the ISA to begin with. So I think it would be a great model for a federal program, and I think schools should be required to put some of the financing for the ISA up front and then share in the returns. Because right now, one of the many problems with the student debt system is there's a total misalignment of economic incentives. The risk of paying back that debt is totally on the students, or ultimately the taxpayers, which a lot of it's going to land, I'm sure, if the students can't pay. The proceeds are going to the educational institutions that have no financial risk. And that's not to disparage anybody's motives or incentives, but I'm talking to an economist here, and this is just the wrong way to say, follow the money. You got to, what kind of incentives are you creating in a system like that? And we're creating a system where there's been very little discipline on tuition increases or room and board fee increases, because especially with these Parent Plus loans, and you can get something called a Grad Plus, it's all based on the cost of attendance. So, so schools can keep raising the cost of attendance, and the federal government has backfilled with these direct lending programs. So I would scrap debt, at least for undergraduates, and go with an ISA model with aligned incentives so that the schools themselves have to provide some percentage of the funding.
As an economist, it looks to me like you're suggesting swapping equity for debt.
I
which,
am doing
in
that.
a sense,
Actually,
now I have to be
absolutely
careful
doing
about
that.
because slavery has been outlawed. But nonetheless, you are taking sort of an
you know,
equity
people
share
say
in their
that,
future
yeah,
income.
So this is like indentured servitude, and it's not. Like debt is not imposing horrible burdens on people. No, but it's capped. It's an affordable percentage. It's based on what you actually earn. It's capped, and then when you're done, you're done. So a lot of the income-based repayment plans that they have now, and there are a host of problems with those we don't need to get into, but usually, unless it's public service loan forgiveness, which actually is very close to an ISA, you've got a big tax bill. So it's still debt, and if your income is so low, you're not covering your interest. You've got negative amortization of your principal. You're actually owing more, and then you've got a big tax bill at the end. So they're not well-designed programs.
Yeah. Let me close with something that I know is close to both your heart and Olivia's, which is financial literacy. You've written, I think, a couple of children's books, and Olivia's been giving some, I think really frightening numbers about how the U.S. stacks up relative to a lot of other countries in the basics of financial literacy. That strikes me as one of the most serious obstacles facing Americans who are more and more being responsible for their own post-retirement income. Defined benefit plans are virtually phased out. It's all about defined contribution, and I have the impression that even among Wharton students, not that many are well prepared, I think, to take it on. We try. If they've taken Olivia's course, they're in great shape. I hope they learned a little something from mine, but a lot skid through without really paying much attention to those issues at all. What do you think could be done to help the American public become more financially literate and more attuned to what they need to do to save and how they need to invest the savings to be able to retire comfortably?
Well, we have a couple of financial education experts up here, so they probably have more thoughtful things to say than I, but I used to be the Assistant Secretary for Financial Institutions at the Treasury Department in the early 2000s, and I created the Office of Financial Education then, and one of the things we pushed then, I think we've had some progress, but not enough, was getting financial education as a standardized part of the curriculum. I mean, they're building it into math. Math really seemed to be the best place to do it, but of course it was offered year after year to kind of just make it a standardized part of what kids got year after year. A lot of schools offer, one-off financial literacy courses, particularly in high school. I think those are helpful, but I think, again, if it's not connected, if it's not done year after year, I'm not sure how much it sticks. And so, I encourage that, but I think it really needs to be a standardized part of the process. I just think, a better recognition of the need for this as well, because, I have written a couple of children's books on financial education. They were fun. I tried to make them fun. We actually use fictional stories to try to illustrate basic financial principles. And I've got a new manuscript out, but I'm still finding resistance in the education community. It's just, we'll get 20 books on dinosaurs, but something on compounding interest. Why is that hard? So it's, I do think that's part of the educational establishment, at the elementary and secondary levels in particular, they just need to get more religion around this and how important it is. But we're still fighting the good fight, and there has been some progress. Though you look at these test scores and survey results, and it's pretty disheartening. Just even percentages. High school graduates don't even understand percentages.
Well, I would be delighted to talk with you all afternoon, but it really is more than time that we let the rest of the audience. And I'm sure you have questions for Sheila. Please raise your hand. Yes, please. Oh, okay.
Introduce yourself, if you would.
Hi, I'm Karen Dinan from Harvard University. I just want to push you a little harder on the income share agreements.
Okay.
I was very interested in what you had to say, but I was wondering if you were worried about consumer financial protection issues with the industry the way it stands. From what I can tell, it's a largely unregulated industry. So nothing is requiring the institutions offering them to actually offer students a good deal. I guess it doesn't bother me so much that Purdue and other nonprofits are trying to put together what I assume is a good deal for the students. Right. Some of the coding academies have been accused, at least, of putting together deals that have a very high implicit interest rate. And on top of that, if you just go on the internet and try to, you search for income share agreements, you can find companies that are offering them to fund your vacation or fund your wedding. And it just seems like you're getting really far afield, and the lack of regulation just seems kind of troublesome.
So I think the lack of regulation is a huge, and I'm a big ISA fan for the government to offer it, right? And these nonprofit colleges, I think, have also done a great job of pioneering programs that could help inform a government program. But my primary interest is a government ISA program. Getting rid of debt is a model for the way government funds at least undergraduate education. There absolutely have been abuses, and it needs regulation. And I think there have been bills to let the Consumer Financial Protection Bureau start regulating it and putting some, parameters around what's a reasonable repayment schedule, what the outer caps should be, better disclosures. Though I will say, I think ISAs are maybe easier to explain than debt, because it is just a contract for a percentage of income. If it gets interest and late fees and all that kind of stuff, so it may be easier to understand. But there again, if the provider is not a person or an entity of integrity, then you've got an issue. So they absolutely need to have some kind of framework around it, and that's been pushed. And ironically, I think some of the opposition to it has been they feel like if they put a consumer protection framework around it, it's going to somehow validate it. So, I don't think that's right. I think ISA's done right. It's a perfectly valid and helpful concept for at least for student financing. But that's been one of the kind of funny arguments against a consumer protection bill in Congress. Yeah.
Hi, I was very interested having a college-age student at Northeastern, hearing your discussion there. It strikes me a little bit that a lot of the policy discussions are around how to pay for things. Like, right. It almost reminds me of healthcare. It's about how you pay for it rather than getting the cost down in the first place. Mm-hmm. Are there too many colleges? Should colleges fold? Should there be consolidation? Should there be focus on that side of should everybody be told they have to send their kid to college? There's so many things that need to be done, I think, at that end of the market, and a lot of the discussion is always on how you pay.
Yeah. No, I agree, and I think all these programs, whether it's more home ownership, whether it's education, whether it's healthcare, they start with the best of intentions. We want to broaden access to it. But what happens is the providers of the service co-opt the program, not the users, but the providers. And instead of expanding access, the costs go up. And you can see this time and again. And so, yes, I do wish policymakers, and getting back to the student debt example, you could not have designed a program that would be better at incentivizing institutions to raise tuition. That's how it was built. That's the kind of incentive it creates. And in healthcare, you can make the same analogy. And certainly with subprime mortgages, the incentives were a little bit different there. But nonetheless, the people that were providing the mortgages were the one making money, and it ended up hurting home ownership for the lower middle income people who we were trying to help. So yeah, no, I couldn't agree with you more.
Olivia Mitchell from Wharton, thank you very much. This has been a fascinating discussion. I wanted to try to divert or turn your attention, if I could, to the broader context of this symposium, which is about the role of debt in an aging economy, and whether you can share with us any thoughts you might have around how we should perhaps rethink the role of debt as our workforce grows older and as our population lives longer and maybe doesn't continue to work. So any sense there?
Well, it's a challenging question. I mean, I think this is a more indebted retirement generation than we've seen in a long time. I think a lot of this is an outgrowth of still lingering impact from the financial crisis. Some of it is symptomatic of more abundant wage growth. We haven't seen that recently. It's been, there's a whole host of challenges I see for retirees, and I'm one. Is so fewer number of kids to maybe help you. The end of defined benefit plans. So if you're lucky, you've got a defined contribution plan, but you have to manage that risk yourself and figure out how to draw that in a way that's going to be able to sustain you over a period of time. And so I think it's symptomatic of the broader problem. And then the wealth, whether it's retiree wealth or any other, you have to look at how it's distributed and how it's the concentrations of wealth with very wealthy people, and not so much for the rest of the country. So I don't know what the solution is. It's kind of we're in it now, right? And people are working longer, right? Women especially are working longer. They're working far past retirement age. It's going to eventually fall on their kids as well. I don't see any short-term solutions. I salute this conference for trying to find some. I mean, but maybe just as an equity model may be better for financing. Maybe we need to think about equity more. I know there's some fintechs, and I'm always nervous about talking about these because some of them do it right and some of them are not. But there are some fintechs now that are trying to enable older people to sell off equity interest in their home, as opposed to if you do that instead of reverse mortgage, power to you, because I think that's a much better way to do it. But maybe some technological innovation along those lines and shifting more to equity so that whoever's providing the financing is going to share in both risk and returns, and better aligning the incentives of again, the funder as well as the recipient of the funding might be a longer term solution. But for now, we are heavily reliant on debt. It's really hitting older Americans, and I don't see any near-term solutions to it.
The other part that I worry a lot about is simply a future that looks like it's going to have much lower returns. And that with interest rates that hardly cover the cost of living, it's just not a very encouraging prospect for hoping to earn enough in post-retirement wealth to sustain you. It's a very, very ominous picture unless we can do something to improve productivity and growth.
Well, that's right. And even the people lucky enough to have their 401ks, they're staying in equities, right? And they but they probably shouldn't be, but they put it into a treasury. They're barely going to make inflation.
Well, quantitative easing is all about trying to push us all into taking more
risky assets, right?
And we're doing it, and we may live to regret it.
Yeah, because retirees should not be
later.
risky assets. I couldn't agree more. Yeah, again, Marie.
I want to push you instead on the last topic you talk about, which is financial education. And, as you know, Olivia and I have written a lot of papers on this, but, even as 2019 and after 15 years of writing about this topic, I think we actually still find, probably like you, a lot of resistance. Still, even at this conference, there were a lot of voice against financial education. And just 2 or 3 weeks ago, there was an article in the Washington Post arguing we should not do financial education in the school, is a waste of time. And I really feel like, ignorance is not an option. But so I wonder whether you can speak a little bit about, what do you think it might be more effective in terms of, clearly we have shown that, people do not have financial literacy, but when we speak to regulator in particular, I think they have an instinct to protect, but not an instinct to educate. So, is there something that you think is missing? Potentially more effectiveness or more study on that, or more showing the macro impact or so on?
Well, I don't want to get the education publishers and teaching community off the hook. I do think, I remember I wrote a book called Isabel's Car Wash. It's about a little girl who, it's about risk and return and how equity works basically. And so she wants to buy a doll, and so she starts a car wash, and she needs $20. She needs $10 to buy the soap and everything. So she goes to her friends, and they each chip in $1, and then she's successful, and she pays them a good return on their investment. They double their investment. And then I had a little bit at the end about the stock market and all that. And it sold well, and it still sells well, but I got this kind of subterranean chatter, but oh, Sheila Bair is trying to get people in the stock market and all this kind of stuff. And I'm going, it's like financial education is somehow promoting Wall Street, or they kind of have that view, and it's just the opposite. It's trying to protect them from Wall Street, So I don't, I think there does need to be some better education among the educators of why this stuff is important. And, kids need it. They want it. And actually, if I was a math teacher, I think I could make my class a lot more glamorous if I could talk about how to borrow money to buy a car, or pay for my college. I think it makes it relevant to kids, and actually tying it to transactions so they know eventually they're going to have to make. It will get them more engaged. So I don't want to give up on that. I think regulators need to make sure disclosures are as clear and simple as possible. We have truth in lending, which I think with the private sector lending, which I think has been can always be improved, but it has been.
But when it ends up being 80 pages that you have to sign off,
and that's the regulators, and so you get the regulators coming in, and the lawyers, everybody's trying to win their lawsuit, right? And I got to tell you, that having been lobbied on both sides, the consumer groups can be as bad as the industry sometimes, and coming in because they're relitigating a case they lost, and so they want 5 pages of this or that. And so they're thinking in terms of that as opposed to what's going to be meaningful to the consumer. So we should take regulators to task for that as well, that these disclosures need to be very clean and simple. And maybe this is controversial, but maybe it's some products, especially for vulnerable populations, shouldn't be that complex. Maybe we don't have product approval in the U.S., and that's not part of the Consumer Financial Protection Bureau's remit. You have a concept like suitability on the security side, but you don't really have anything like that with credit products. But some of these products are just so hideously complex, even with I couldn't figure them out. I mean, like the subprime mortgages are a prime example. I had teams of my supervisors who were going through these mortgage documents, and to actually figure out, what the tricks and traps were, what the reset payment was going to be. It was very, very difficult. So, maybe tackling product complexity, at least for retail products, is something we should be more open to.
Another thing I would suggest is that maybe it's worth targeting schools of education. I don't think you could find a single school of education in the United States that even touches on financial literacy. They don't even consider it part of their mission in life. Yet, when you look at the actual problems that confront people when they emerge from the educational system, that's really near the top of the list.
That's true.
Steve.
Steve Zeldis, Columbia. Can I push a little harder on this product complexity? Just push a little harder on the product complexity question. I mean, how do we go about making financial products less complex when there are economic incentives by some of the providers to make products more complex, specifically so consumers won't understand them and will end up paying the institution more in fees? And so how do we push on that from a public policy perspective or from a private sector perspective?
You'd have to have some type of, you could have a pre-approval process, or you could do it through liability, right? So you could just have something like a suitability standard that they have in securities, and just set some standards that say products that are this complex are not suitable, and we could go to litigation. You could have it either way, I think. The industry would probably would prefer pre-approval. That's going to slow down product innovation. But, again, for the retail general public side, I don't know. I've just been watching this for so many years. I'm a Republican. I'm a market person. The older I get, the more regulatory I get, I guess, because I just become so disillusioned in how people are ripped off. It's just, and it's not just finances. It's your cell phone bill. It's your insurance contract. It's just like this whole idea is to camouflage how much you're really paying to get you to pay more. And so it's not unique to the banks at all. Yeah.
Well, thank you, Sheila.
Yeah, no, my pleasure.
Welcome.
Nice to meet you.